welcome everybody. I'm so happy you could all take the time to join. This is our first ever speaker series from we've started a business network at the Spanish, and I think that this is really our first effort at it, and we're starting with a series of 4 speakers over two scheduled in April and 2 scheduled in May. And so this is really the start. And while we'll do speakers, and hopefully we'll also be able to do some live events as we get closer, as we move on during the year. I know Zoom is super convenient, but it'd be nice once in a while to maybe have have some live events. And once we have this network put together, we're gonna figure out ways to provide value to everybody, from networking to education to whatever it happens to be. So I'd like to introduce Oren Gabai, who is a member of our synagogue. Oren is he's actually part of the family. He married my niece. We were always friendly before. He's kind of a guy who was like, he's much younger than me, but we've always sort of related with each other on a very even basis, regardless of our ages. And it's still that way today. He's extremely enterprising, very passionate about what he does. And so now I'm happy to have Oren talk a little bit about his business evolution. And following that, we can open the floor to questions. The floor is all yours, Oren.
Thank you, David. Thank you for the introduction. So hello, everybody. Thank you for coming today. Just want to thank everybody for joining. So like, as David just mentioned, this is our first session on our Spanish and Portuguese business networking event. There's one of 4 scheduled, and I think we're always going to try and have an entrepreneur do a story and then have a guest speaker, who in this case is Lorne Steinberg from LSWM, which stands for Lorne Steinberg Wealth Management. So my journey, I guess, is the story of how did I get where I am now? I guess my first entrepreneurial venture, I was probably around 10 years old, selling my mom's baked goods at highly inflated prices over at One Should, which resulted in a phone call to my mom telling me to stop doing that. I'll skip that story and I'll fast forward another 8-9 years. When I was 17, I started, I got to drive, and my father got my sister and I a car, which was great. And then I soon realized that having a car and all the freedom doesn't do much if you only have $20 a week of discretionary income to spend. So I wanted to make some money. Didn't really want to get a part-time job because I was in school, and my best friend and I started discussing the situation of having freedom with no money. And he had mentioned that his brother had invested in a few gumball machines and placed them around town. And I thought that was a great way to make some money. But I said, hey, vending machines would probably be better instead of making, 25 cents on a gumball or some, peanuts or whatever it is. You can sell a bit more. So I went to go see my father, who's an entrepreneur, and told him that I had this idea of buying some vending machines. And he said, well, why don't you sit down and put it on paper and write a proposal and show me what the numbers look like. I was around 17 years old at the time. So I put it together and I did a little letterhead, and I sent it by fax. I faxed it to him because it was 1996, 97 at that point. And I didn't hear back from him. So I called him up about a week later. Did you get my proposal? And I'm very busy, Warren, leave me alone, please. I said, okay, no problem. So I left it alone. And then maybe about a month and a half later, I get a call, and my dad says, okay, you owe me some money. I said, what do I owe you? He said, oh, you owe me $2,000. I bought a soda machine and we're going to place it at the family business for you. I said, okay. He said, you actually owe me more because you have to get some inventory into the machine also. We'll deal with that after. So that's how I got started. We put the machines in, made a little bit of money, and then went and decided to buy, a snack machine with the chips and the chocolate bars, and then eventually a coffee machine, and had my 3 machines. I was making a little bit of extra money, and that was nice, going once or twice a week to check up on them. And then a family friend also had a factory who was unhappy with the service they were getting from their vending machines, who was a member also at the Spanish and Portuguese, oddly enough, and said why don't you come and bring some machines over here? So then I went and did the same. And at this point, my mom became the banker, not my dad. And my mom was very supportive of these sort of things. So she would lend me the money. She had a little ledger every week. I had to pay back X amount of money towards the machines from the profits. And then by the time I was around 19, 20 years old, I had built it up to around 20 machines. And I was making about $1,000 a week which I had to pay back my equipment with it, but it was quite a bit of money for somebody at that time to do while, still in school and all that. And it was a great learning curve. Then a couple of years later, around that time, my cousin Davin Sufer, who's actually, I think, in attendance today, was at engineering school over at the University of Waterloo. And he heard about my business venture and he said, why don't you go ahead and, go start buying machines like crazy and putting them everywhere. And I told him there's issues with control, there's cash, there's theft, and I'm not sure how you keep track of it on a large scale. So he mentioned to me and said, well, don't they have counters or any type of inventory devices? And I said, the new machines do, but you have to download the information with some sort of like handheld Palm Pilot back then or whatever it was. And he said, that's great, but wouldn't it be great if you could remotely access that information from your house so you know whether or not you had to go fill up a vending machine? And I thought, wow, isn't that just an actual great idea? So I said, hey, he was a smart guy, one of the smartest people I know. I said, can you build that? He said, yeah, I think I could build it. So we made a deal that he would build a prototype and I would write a business plan and we would try this little technology venture. We went into the exciting world of vending machine technology. So we went out there, raised some money. We raised about a couple $100,000 through government programs, R&D tax credits, and all that stuff. And we sold a modest amount of units. We were there, but it was sluggish. It was a tough business, and we learned the toughest lesson about, I think, entrepreneurs find out at one point is that timing is really not everything, but a lot to do in business. And what I mean by timing is not only that the market has to be ripe, you have to have staying power. As markets become more ripe, other players start coming in, and there's a lot of unknowns that come around with doing that. So at this point, we knew that we would have to go deeper into this business, and we weren't sure what the long-term potential was. We also knew that eventually cashless payment systems were going to come into effect, and that would also potentially circumvent our technology at that point. And we were in our mid-20s at this point, and we wanted to start our lives, get married, and start that next moment. So we decided to unwind the business. And I realized something at that moment was that I was more of a brick and mortar type of business guy. I preferred buying something that cost me X and selling it at Y and making contacts and building relationships rather than funding and doing technology ventures and Series A and Series B. It just my character did not work well with that type of business. So I went up to my dad at that point, who was in the trucking business. I told him I evaluated my options and I've narrowed it down that I essentially would want to go back into the vending machine business, go maybe buy a route for maybe 100 machines, apply my technology and run it because I knew the business very well, or I wanted to come work in the transportation and logistics business. But those were the only two things I wanted to do. And he asked me why. And I said that I didn't really want to start learning an industry from scratch again. And I learned that learning an industry, by the time you learn the ins and outs and where you can make money and where the pitfalls are, it takes time. And I felt that if I worked with him, it was my preference because I thought that the trucking industry had a lot more potential than the vending machine industry, which he agreed. And the family business at that point didn't really have a sales team of people going out to do business development. So that's what I went to do. I went to go work for the family business, and coming to work in a family business is not always as easy as it sounds. I knew I had to make my mark. So I did what I always did, is I tried to make rain, as they say. I took business listings and just started hammering on the calls, trying to get accounts, trying to open business. Knew that if I opened new clients, that I'd be cutting my teeth in the business. And it worked. I started getting some new clients who were replacing a lot of our existing business with better paying business, which was a good thing to do at the time. And then I got the call one day driving home. Son, you're going into dispatch. I don't want to go into dispatch. I don't know anything about dispatch. Well, you're going to have to learn because I got a problem. We have a night guy who left and I don't have anybody to replace him. And I just need you to do it. So I jumped in. I had to figure it out, as they say. Jumped in the water. After a couple of weeks, I called my father and said, look, we got a good system. We got a good computer system. We got some good people, but there's no processes really in place. We're really just using our computer system to log historical information so we don't lose track of billing or stuff like that. But we're not really using it to drive the business. And he said, look, whatever you want to do, just go ahead and do it. It's been a long time since I've looked at it. So see whatever you can do to retool. So that's what I did. I started to make changes. And I realized at that point that had I not done the technology venture with Davin, my cousin, I never would have known how to go about doing all that sort of stuff, working with databases, working with in development and developing reports and so on. So I started doing that. And then some opportunities came up. Competitor went out of business. We picked up some of their clients. We took a couple of the things that come up as business goes, and we were able to execute very, very, very quickly. because we had these processes and these systems that we kind of learned through the, doing it the first run, which is, with my first try at the business. So fast forward a couple of years now, the company is doubled in size. It's doing well. Everybody's happy. And I got to a comfortable point. Now, being comfortable is nice, but being comfortable can also be very dangerous, is my experience in business. And I noticed that I was starting to feel a little bit complacent. I was still very motivated. I was still going to work early, doing a full day's work, but I just didn't really feel that I was applying myself to my full potential. And I had become what I call is that guy. And that guy in the business, what I mean by that guy is I was the only one who knew how to take care of this specific issue with a client or that specific issue with a driver or whatever it was. And I just said at one point, I didn't necessarily just want to do that. I was 36, 37 years old, and I was still fairly ambitious. And I wanted to go ahead and be able to do more than that. And I knew I had to start making some moves for that to happen. So I made the realization that the transition that happened at Argus, which is the family business name, was probably not just unique to us. There's probably a lot of trucking businesses that have the same issues where there's some succession issues or skill sets that are not necessarily there. And I thought that I could probably apply this experience. So I decided to try my hand at doing some acquisitions. What we did at that point is we put our, I joined some business listings and got some names of some companies. And there was a small transport company based in the South Shore, Quebec. And I had a feeling that I knew who they were based on the description, and decided to give it a shot and buy that business. And we bought the company. We ended up realizing synergies fairly quickly between the two entities. And right away, we got a very, very good return on investment. It wasn't a huge company, but it was a good return. And I just, that's where we started. After that, we had another company that decided to close down, and we had a couple of employees working for us that knew people there. So just one day, just called everybody up, called them up and just hired a whole team of about 7, 8 office people and 12 drivers overnight, and just decided to go and try and build something out of it. I had a feeling that we would be able to do it, and my feeling was correct. The market was very favorable at that point. There was a lot of demand. So all the employees went straight to work. But the best part about that, that venture was that we ended up getting a very, very strong management team. A lot of the people that came on from there were very, very talented, and were able to bring in other people. And we got the core team that we needed to be able to do what we wanted to do next, which was to start doing, more business development, more implementing more strategies and so on. And that's what we did. After I had the team in place, I just started focusing on further acquisitions, buying up other companies that were a bit smaller than us, some bigger than others. And just doing what we did, looking for synergies between the different companies and opportunities that may or may not have existed, and applying whatever we learned over the years into the business. And it's all in all, it's had its ups and downs, but it's been a successful strategy. And over the 5 years, we've completed about 9 ventures in total. And so the company looks very, very, very different today than it did from that time where I kind of had that call of awareness moment or aha moment of where I wanted to be and what I wanted to do. And I think, at the end of the day, when I put this little presentation together and I was reading about it, I just kept thinking to myself that, some of the things you got to do in business is stick to what you know, as they say, is a good thing to do in business, but it's a double-edged sword, because you also have to put yourself out there and try new things in business, or because the situation changes on you. And if you just stick to what you're doing, eventually, you have to evolve, is essentially what I'm saying. And I just felt the best way to evolve was, I just kept coming back to this swimming analogy, that at the end of the day, you got to be a swimmer. You got to jump in the water, and you got to be not scared of the water. That's the first step in entrepreneurship. And then when you jump in that water, there's different things you got to do at different times. Sometimes you got to sit and tread water. Other times you let the river or the current take you, because the current might take you to some good places. Hopefully you won't get your head smashed on a rock on the way, is because, at the end of the day, luck is a big factor in this stuff, and hopefully not getting dealt something too horrible along the way. But if you make it through those different areas, at one point, you get opportunities and you get to leapfrog. And at one point, one opportunity begets another opportunity, and you get to level up, and certain situations happen that if you weren't going to put yourself out there, you never would get there in the first place. So it really, at the end of the day, it's just my venture. What worked for me in the end was knowing what I was good at, but putting myself in situations where I was constantly challenging myself and looking for new opportunities. And I've been definitely blessed and fortunate. I had been surrounded by amazing people, from my father from the beginning, Davin, who I mentioned, and more recently, my family, Karen, and my team members, who have been tremendous over the last few years. I definitely would not have gotten to that point if it wasn't for them. And from here on out, that's what we're focused on. I was just speaking to Lorne and David before we got on. It's all about managing people and personalities, and that becomes a new challenge when the company gets a bigger. But we're learning, and we keep evolving. But it's all in all been a very, very fun ride, and I hope there's still some good chapters left to come up. So I hope it's not the end of this story. And I hope my head doesn't get smashed on a rock at one point in the river. So thank you all for taking the time. I don't know if David, if you want to see if anybody has any questions or go ahead.
That was awesome. Thank you very much. I'm gonna ask one question.
Go for it.
Which is, have you in your, and by the way, I think it's you got lots of runway left. You're still really young. And super ambitious. So, and I'm sure you're going to continue to be very successful. Is there one time you faced serious adversity? And if there was, how did you manage to deal with it? Maybe not the nuts and bolts, but more on the emotional, side of things.
I did. I would say there was a couple. I would say there's the dynamics of being in a family business at one point. Like, if you're somebody with my character who wants to build and go forward, at the end of the day, it still is a business where someone else founded it and all that sort of stuff. But I think the key point for me with the adversity was that aha moment that I had was just simply that I needed to be ready to put myself out there. It was, when you're in a family environment, it's tempting you're protected to a certain degree. So you want to stay to a certain degree, kind of, I'll run this by so-and-so and see what I think. But at one point, you do have to put yourself out there and realize that the big moment for me was realizing that if you have to do something or you're nervous about doing something, you don't have to do the whole thing right off the bat. You can go and you want to buy somebody, for example. You can have a discussion. Should we look at this person or this company? Should we consider it? Or you could just go ahead and just start the process. You can start the process and start doing your homework, negotiating, and then present it later and say, I did all this, I did all that. And if it's a good opportunity, people will generally see it's a good opportunity. If it's not a good opportunity, your banks and your other partners or stakeholders will tell you we don't like it for the following reason. So I think for me, the big adversity for me was just kind of realizing that, you make your own bed, no matter what the scenario is. And I had a hard time, I struggled with that at one point in the business. Just realizing, not being scared of putting myself out there and failing. I have been a bit fortunate, and the first business with the vending machines was very tough. Starting something from scratch, and building it. And Davin, if he ever wants to jump in on this call, he can talk about his part of it. But it was very, very tough. It was a tremendous learning experience. The family business was a going concern, and I had the benefit of having a very, very, very amazing father to help me through those difficult adversity times. But I think for me, the main issue I struggled with was figuring out who I was as an individual, and just going out there and really going for it. And just realizing also at one point that your weaknesses are fine. It's okay. Like, you don't have to be great at everything. No one's great at everything. If you're good at a lot of things, that's great. If you're not great at everything, you're human. So, and then in terms of challenges in the business, I just felt the right way was just always to break it down day by day. Look at the problem at hand, break it down to its parts, and just address each one of them, one piece at a time. And somehow, with a bit of average luck, I call it, just not horrible luck. I think in business, pray for average luck is what I always say. Don't ask to win, don't ask for a jackpot. Just don't ask to get cracked. And often if you work hard and you just break it down and do your best, I found that things tended to work themselves out. But I do believe that a lot of that adversity was mitigated by the benefit of having someone like my father to coach me and help me along the way.
Awesome. Thank you. Does anyone else, we have just a few minutes for questions. Does anyone have anything they want to comment or ask? If you do, go ahead and unmute yourself and ask.
I was just curious, Oren, was there a time where you were like fed up and you said, you know what, forget it, I'm gonna quit? And how did you motivate yourself not to quit?
I'll be honest, I never had that. I had the first venture. I knew I had to make a change. I think when the first venture, when I went to see my dad to speak to him about it, he just felt terrible because he knew how hard I worked from maybe age 19 to 25 at it, which is a very crucial time in your life. You know, it's a time to travel and it's a time to party and have fun. And I was, toiling and working at that point. But he was surprised that I didn't have any issue about the failure of it. I knew that it wasn't a failure. I knew that we did our best and it was a great learning experience. And David and I both kind of said, this is like, an MBA school on massive amounts of steroids, which is what it was. But I don't. I mean, I was speaking to David about this yesterday, like as an entrepreneur, and I don't know if anybody, there's an issue of falling in love with the romance of entrepreneurship is what I've learned. It's not as fun as a lot of people think it is. And at the end of the day, I can speak for myself, and I think David's a bit similar like that. I know my father's a bit like that too. I'm pretty consumed with business and entrepreneurship from the minute I wake up to the minute I go to bed. For me, it's beyond a passion. It's just what I'm about. It's what I'm built about. So no, I don't think I've ever really ever considered quitting. And I don't think I will ever, I think if failure should come, it probably would motivate me to try and rise above it and get above it, to answer your question. But that doesn't mean that I'm normal, and it doesn't mean that that's a good thing necessarily. It just means that that's just the way I'm wired, I think, to be honest.
Okay, maybe if anyone has, we can take one more question and then we're gonna continue. If anyone has a question, you can unmute and ask. Once, twice, 3 times. Okay, thank you. So Oren, please go ahead and introduce Lorne.
Okay, so I just would like to introduce Lorne Steinberg. So Lorne Steinberg founded Lorne Steinberg Wealth Management, which is LSWM, with the vision of providing investment counsel services to high net worth individuals based on principles of integrity, transparency, trust, and capital preservation. Prior to founding the firm, he was president and chief investment officer at AGF's investment counsel business in Montreal, Magna Vista Investment Management Limited, which he joined in 1999. Before Magna Vista, he spent 10 years at Lafferty, Harwood and Partners, where he began as a research analyst and was later responsible for the fixed income desk. Lorne received his MBA from the Wharton School of Business of Pennsylvania and his BA from McGill University. He has been a chartered financial analyst, charter holder since 1996. So without further ado, Lorne, if you want to take the floor, please. Thank you.
Thanks very much, David, for inviting me. Thank you all for being here. And Oren, thank you very much for that inspiring personal story, I have to say. Whenever I hear an entrepreneur tell me a story and talk about, what's gone well and what's not, it actually inspires me. So I'm grateful to you. Thank you very, very much. Today, I'll just run through a little bit about, how our firm sees the world we're in, both, from an economic standpoint and also as investors. And I'm happy to take any questions that you may have. So I'll just put my presentation on the screen. The painting on here you may or may not recognize is by Paul Gauguin when he was in Tahiti. And it's the eternal questions we all ask ourselves, especially during what often seems like difficult times. And ultimately, where are we today and where are we going? And with everything going on in the world, as business people and investors, there's a lot of discomfort happening because of the war in Ukraine and rising interest rates and inflation. And so we'll just kind of address this as a theme. So I'll just talk about really our State of the Union, as we call it. We every few months, we sit back as a firm and the research team gets together and takes a step back because we have to look at how we're positioned for the long term. What is our economic outlook? Obviously, the impact of interest rates. The Bank of Canada raised interest rates by 0.5% this morning. How does that impact markets? How should investors be positioned? And we'll talk a little bit about asset allocation. And the nice thing about being in the investment business is you make mistakes all the time because you don't buy things at the low, you don't sell things at the high. And unfortunately, there are many things you buy that go down and things you should have bought that, went up. And so I'll just give you a brief background to that. So every quarter or so, our team sits down and has what we call our State of the Union. It's a little bit less formal than the one that is up here, but it's an opportunity for the team to really sit down and ask ourselves, what are the key issues that we're dealing with? And at the present time, the slide has changed over the last year or so. We look at, the political dysfunction that exists, geopolitical risk, inflation, interest rates, supply chain, which is a huge issue. And Oren probably has something to say about that as well. And ultimately valuation, because we're trying to buy things that are cheap and hopefully, they're cheap enough that we make a good return on them. So political dysfunction has been with us seemingly increasingly all over the world for the last number of years, but it's really picking up. And now even in Canada, as we're seeing the leadership race for the Conservative Party going on. And people often look at political dysfunction as being a negative thing, and to some degree it is. But there's another side to the political dysfunction, which is, and you see it in the US, where the parties aren't able to agree on very much. And so the landscape from a policy standpoint for businesses is actually pretty stable. So Joe Biden tried to raise taxes on people making over $400,000 and it wasn't successful. Then on people making over $1 million and it wasn't successful. And then even a billionaire's tax wasn't successful. So there's actually a fairly stable environment that is created through political dysfunction. I won't say much about geopolitical risk, except obviously the war in Ukraine, a human tragedy, as we're all aware of, is moved to the forefront and knocked everything else geopolitically off the table, and is resulting in elevated levels of inflation and other types of dislocations, which is impacting basically everyone. Supply chain issues, which almost didn't exist up until the pandemic. This is actually a true sign from a Dunkin' Donuts in Baltimore about a year ago, stating that they're out of donuts, but they have bagels and muffins. Supply chain issues are a major issue for many, many companies. The semiconductor shortage is affecting all kinds of industries, but especially the auto sector. However, our view as we look forward is some of these supply chain issues are really have peaked and are starting to abate. There's been a shortage of automobiles, but Ford, GM, and Hyundai said in February that they expect to be back at full production by the end of the year. So as tough as these dislocations have been, our view is that supply chain issues will start to abate, have already started. And even things like the semiconductor shortage, semiconductors will be back in reasonable supply demand by early next year. Of course, inflation, which has been really dormant since the early 80s when we had those periods of double-digit inflation, suddenly over the past several months, and increasingly so, March inflation in the US was 8.5%, the highest inflation in 40 years, and even taking out food and energy was still 6.5%. So high inflation is having a massive impact on businesses and especially consumers. But again, I'll get into this later on. It's looking to us like the inflation rate has probably peaked or is peaking here. And of course, this is a chart going back to the early 80s when a number of clients of mine said, Lorne, I wish I had bought 50-year bonds yielding 10%. I wouldn't need you to manage my money. Because interest rates used to be, double digits in the early 80s, and then they came down to almost zero. And finally today, we can state that we're at the end of this zero interest rate environment where people were borrowing money for next to nothing and leveraging themselves, et cetera. It's amazing how fast things turn. You could get a 5-year mortgage for about 2% 6 months ago. Before we had this session, I just went on, TD mortgage rates, and a 5-year mortgage rate is now about 3.75. So there's been a huge increase already in the early stages of a rising interest rate environment. And rising interest rates will have an impact on valuations both for private companies and public companies. This chart shows you, if we go back to 2003, 2004, this is telling you that leveraged buyouts were done basically for, a valuation of 7 to 9 times EBITDA, average valuation maybe 8 times. As interest rates went down, private equity firms and investors could pay much greater multiples and still make money. And so as interest rates went down to these record low levels of almost zero, more and more the acquisitions were being done for 11, 12, 13 times EBITDA. And so the question we have to ask ourselves is, if every valuations rose when interest rates were going down, what will happen when interest rates go up? And the obvious answer, and this is true for real estate because virtually all real estate is bought with leverage, is that if you're paying more, if your rate of borrowing goes up, then the value that price you're going to pay is going to go down. And so rising interest rates are going to have an impact on valuation going forward. So this is Jerome Powell, the head of the Fed. And this is a famous painting called The Scream by Edward Munch, because everyone is concerned that if the Fed cranks up interest rates, as they are going to do this year and probably next, is that going to cause the stock market to fall? Is that going to put the economy into recession? And our belief is that we should not fear the Fed, that rising rates are actually healthy up to a certain point, and will leave us in pretty good shape. So this is the IMF growth projections. And because of inflation and rising interest rates, you can see that the IMF is projecting slowing growth, but still very healthy growth through this year and next. Let me state that this chart was done actually just before the Ukraine war. And so there's no new chart available, but our belief is that the Ukraine war and resulting, increase in petrol prices and the like, oil and gas and food will probably knock about 0.5 point off these growth projections. But the message is we still expect to have pretty decent growth for the next few years. And one of the great fears, especially in the housing market, is if interest rates go up, and they're going up and mortgage rates are up, about 40% of Canadians will have their mortgage coming due within the next 24 months for renewal. Is that going to have a big negative impact on consumers in the housing market? Most of you are probably aware that over the last decade or so, we've been reading that consumers have a minimal savings rate and are poorly prepared for rising interest rates. However, one thing that happened during COVID, of course, is that people had to cut their spending because they couldn't go on vacation, go out to restaurants, and the result is that the consumer savings rate went up to the highest level in the post-World War II period. It started to back off somewhat, but the reality is consumers are in great shape and are well positioned to handle some, reasonable increase in interest rates. And also part of this inflation and part of our job situation is with a lack of labor is that wage rates are also rising. And so we do not see that much of an issue with rising interest rates affecting consumers and affecting housing. Regarding the stock market, there have been a number of rising interest rate cycles in the post-World War II period. This just gives you a picture that 12 months or so after the Fed starts raising rates, stock markets usually end up doing pretty well. Stock markets actually go down maybe an average of 5% or so in the early months of a rising rate environment. But the reason that rates usually go up is the economy is in very strong shape. The jobs market is in great shape. And so investors should not fear rising interest rates. I will point out the 72 to 74 period was really characterized by inflation rising and the Fed not acting fast enough. And by the time the Fed realized they were behind the curve, they had to really jack up interest rates. And that put the economy into a serious recession. And that is one of the reasons you're seeing the Fed governors and the Bank of Canada talking about the fact they feel they have to raise interest rates a little more aggressively now so they don't end up behind the curve. But we're pretty bullish over the next few years on markets and the economy. So what is the investor conundrum, and how should investors be positioned? This is on here because this is a book written by Fred Schwed Jr. about 75 years ago called Where Are the Customers' Yachts? And the title of this book came from a cartoon in the old New Yorker magazine. And in this cartoon, a Wall Street stockbroker was taking a client of his out to lunch at the New York City Yacht Club. And he said, you know, before we have lunch, let's walk around the yacht club and I'll show you around. And he pointed to that yacht over there and he said, that yacht belongs to JP Morgan. And that yacht over there belongs to Mr. Sachs of Goldman Sachs. And that one over there is from the Salomon Brothers. And of course, the customer said, that's great that all the Wall Street guys have these yachts, but where are the customers' yachts? And this is just a story of Wall Street and Bay Street are always claiming to, you know, have the right product for the right moment in time, being able to make projections about what is going to happen. And when I think about projections, I think about Jeff Rubin, the ex-CIBC chief economist, who wrote a book in 2007 about why the price of oil was going to go up to over $200 and never come down. And the head of RBC and Goldman Sachs Energy both said the same thing. And of course, a few years later, oil fell to $50. And even today at $100, it's way below that. And really the message is that investing is simply about owning companies, no different from what Oren is talking about when he makes acquisitions. David, as well, is that the value of a business is simply a function of its earnings. And if you can buy businesses at attractive prices, you'll probably do pretty well over time. And of course, you know, this quote's been attributed to many, but there is no such thing as really true economic forecasting, because trying to make projections about what is going to happen 5 years from now is basically impossible. And even though, you know, we try to hold ourselves back, all of us end up being confident about our opinions and think we can forecast. But imagine if we had forecast, you know, 2.5 years ago, and then the pandemic happened and all the forecasts went out the window. So a number of you are probably at or near retirement age and looking at your investments. And investors face an investor's conundrum. Years ago, you know, and even today, many investors don't want to have all of their money in the stock market. And had you come to me early on in my career, in the early 90s, inflation was 2% and Government of Canada bonds yielded 6%. And so investors could have a balanced portfolio, holding some safe government bonds or GICs, beat inflation by a healthy margin, even after tax, and generate a good return. Of course, today we look at, and quite frankly, I put the 5-year bond rate on here, but believe it or not, the 30-year government bond rate is roughly the same as the 5-year bond rate. So investors are only getting a little over 2.5% for 30-year government bonds. And we're in a world where inflation, it's 3+. It's much higher than that at the present time, but even if it comes down, there's no value to be had in regular bonds, which causes stress for many investors. And when it comes to asset allocation, how much should I have in bonds, stocks, real estate, anything else? As a couple of our real estate developer clients have said, in real estate, you make your money when you buy. If you buy a great property with decent cash flow at a good price, you're going to make your money. And if you pay too much for it, you're going to have trouble getting a return. Although my brother hates this story, I will tell you a story about my brother in Toronto who bought a house near Jane and Bloor, which is like NDG, in 1989. And he paid $325,000 for it. And he held his house for 14 years. If I was in person, I would ask you to guess what he sold his house for in a good part of Toronto. Usually when I ask Montrealers, if someone paid $325,000 for a house in Toronto and kept it for 14 years, what do you think he sold it for? People give me answers like 2 million, 1.8 million, because Montrealers think that anyone who held a house in Toronto for a long time could have retired. The reality is my brother bought his house for $325,000 and 14 years later sold it for $375,000. And the reason is, if you look at a chart of Toronto home prices, 1989 was the peak of a real estate boom. My brother was like the last person in and won the high price award. And then from 1989 to 1995, Toronto home prices fell 23%. So it was 325 became about 250. And then from 95 to 03, they rose 50%, and that brought them back to 375. The only message being, you can own great real estate or great stocks, but if you pay too much for something, it's hard to generate a good return. My brother did ask me if I tell that story again to let you know that he did buy another house in 2003 and made money with that one. One of the worst things that happened to me being in the investment business, I have to say, was the internet. Because with the internet, clients can look at their portfolio, 15 times a day, call me up and tell me their portfolio fell, 3% yesterday, what happened. And it's so important to remember that you're not just looking at numbers on a screen. You're buying pieces of a business. Seth Klarman is a great US investor. And when you buy a business, whether it be a trucking business, a lighting business, or anything else, or whether you buy a building, you're buying it as a long-term investment, as something you're going to hold. And so, the price of what makes it successful is, are you paying a good price for the cash flow that you're going to get, and not whether it is in a hot sector at this moment in time. And Ben Graham was Warren Buffett's college professor. And Ben Graham said investors would do a lot better for themselves if they bought stocks the way they buy groceries instead of the way they buy perfume. And what he meant by that is that grocery shoppers are very rational, which is why the most successful grocery advertising is simply sending you the stuff that is on sale in flyers. As my wife would tell you, if the pasta that I buy for $3 is suddenly on sale for $2, I don't scratch my head and wonder, why is it down? I'm the guy with 20 bags of pasta in my cart. Whereas perfume is a very emotional purchase. You walk into, Pharmaprix or something, and, when I walk in there, there's usually a young woman offering to spray something on me and, telling me that if I buy this cologne, I'll be chased around by women. All I can tell you is I've tried it and it hasn't worked yet. So, the reality is stocks will fluctuate, often very aggressively. Warren Buffett pointed out in his letter to shareholders a few years ago that people think he's a pretty good investor and he's done okay because he's a very modest fellow. But he said, if you are a stock investor, the following will happen to you. And he then listed the 4 moments in time when his net worth declined between 37 and 59%. That's what happened to Berkshire Hathaway shares. And he said he never worried about it because he always invested in good businesses. The problem is a lot of Berkshire Hathaway shareholders panicked out and sold his stock at the worst possible moment and never ended up with the right return. And it's just to try to stay rational as market volatility will always be with us. And lastly, as I mentioned earlier, in the investment business, unfortunately, we make mistakes every day. I will say, even when we're right, it sometimes looks like we're making a mistake. Investment consultants for pension funds and the like will often ask you to describe your worst year in the investment business. And my worst year in the investment business was in 1999. Some of you may remember that that was basically the peak of the dot-coms and the peak of Nortel. And the firm I was with at the time, we were value investors. And so we looked at the dot-coms over the years and we could never buy any of them because they were all too expensive. Nonetheless, they kept on going up and our stocks went sideways. And in 1999, I had the worst investment year in terms of relative performance of my career. The market might have been up 30% and we were up 9%. It was painful from a business standpoint because we lost almost 1/5 of our clients. And the ones that stayed weren't happy. And part of the message is that you cannot look very smart in this business for a long period of time. Second thing is, when I come to work every day, I have the 3 biggest investment mistakes I made in my career sitting on my desk to remind me. They were all very cheap stocks, a Canadian retailer, an oil and gas company, and a British chemical company. They were all cheap on every valuation metric. The problem is they all had too much debt. And when you have too much debt and things don't go your way, you end up going bankrupt. And I didn't learn it the first couple of times, but I've learned it now. And Warren Buffett figured this out a long time ago, that you will do a lot better for yourself buying really good, profitable companies at reasonable prices rather than trying to, find the junior gold mining stock or a speculative security. And those are my few words for today. And if anyone has any questions, I'm happy to take them.
Thank you, Lorne. And I'll open the floor.
I have a question, David.
Go ahead.
Hi, David. Okay, thanks. This is Charles. First of all, Lorne, I'd like to thank you. It was a really great lecture. And thank you also, Oren. I learned a lot about you, even though I've known you for many years. Lorne, I'd like to ask you a simple question. You say that you're very bullish, and that gives me confidence, but it seems that there is recession in the air. And what I've been reading recently is that usually when inflation rates are this high, if the interest rate is not matched by the inflation rate, it's usually always results in a recession. And what do you think about that?
Sure, Charles. First of all, thank you for your question. And let me be the first to say there will be a recession. I just don't know when. So recessions are just, part of the world we live in. But the stock market and the economy are far from perfectly correlated. So the stock market tends to go down at the beginning of a recession, and then interest rates start getting cut and the market ends up doing well. When I said I was bullish, what I'm bullish about is the interest rate cycle has just started. So the Fed governors, even though they just raised rates 1/4 point, at their meeting in the meeting notes, they've already indicated that rates are probably going to go up another 1.5% to 2% in the next 12 months. So rates are headed up very quickly, and the next raise will probably be, like Canada, 0.5%. Second of all, this inflation rate, which is highest in 40 years, we see as very, very temporary. And one thing we always have to remember is inflation is 8%. So the price level has gone, the good you bought for $100 last year is $108. Next year, if the inflation rate is 2%, it's 2% on top of this 108. So it's not that we expect prices to go down. It's we expect when we look back a year from now, inflation will be more normalized. And so that's why the 30-year bond yield is telling us. So bond investors buying 30-year bonds are accepting an interest rate of less than 3%. Part of that is due to quantitative easing, and we expect long-term rates to rise to the 3% to 4% level, but still historically very low. What it's telling you is that bond investors are anticipating, as we do, that inflation is transitory, and it'll level off and start to come down. We've had supply chain issues. Right now, there's a shortage of semiconductors. but the three largest semiconductor companies in the world, Intel, Taiwan Semiconductor, and Samsung, are currently investing over $50 billion in US semiconductor facilities, which will be on stream in the next 12 to 18 months. So this is for us, a temporary uptick, and we're going to look back on this 12 months from now, and it'll look very different.
Good to hear. Thanks a lot.
Danny, you have a question?
Well, thanks a lot. It was great to hear. Quick and specific question. Lorne, do you see any good value in any of the Canadian oil patch or Canadian oil companies, or is it kind of like if you are a value investor, is it too late to find value now with the rise in energy prices, and given that Canada is going to be a critical country because of what happened in Ukraine? That's my question to you.
Danny, that's a great question. So our Canadian equity fund has actually done very well, but we have no energy stocks in it. And our view in life is either be early or don't be there. I have to say, when we look at Canada, there is outstanding value, because in Canada, we've taken our most profitable industries and protected them from foreign competition. So everybody bitches and complains that the Canadian banks keep on making billions of dollars, which is true. But foreign banks are not allowed to come in here. So there's no JP Morgan bank branches here because they're not allowed to come in here. So the banks have the market to themselves. And as most of you probably know, our cell phone prices are way more expensive here than they are in the States, because AT&T and Verizon are not allowed to come in here. So as I like to say, I hate being a customer of these companies, but I like being an owner of these companies, because they give us great value, great dividend growth, and we don't have to worry. If you own oil stocks, prices are going to go up and down, and the companies will make money or lose money or raise their dividend or cut their dividend. And we'd rather own businesses that generate more stable cash flow. So now that I've said that oil prices will probably go to $200 a barrel in the next 6 months, you'll say that guy didn't know he was talking about, I should have bought oil stocks. But we just think there's better places to be.
Thank you.
I have a question. It used to be that the Canadian dollar, US dollar, was very attached to the oil prices. And I've noticed in the last couple months with the Ukraine crisis, it's not following like tradition. What's your thoughts on that?
So let me start off by saying I've never met anyone in the Canadian investment business who's ever correctly forecast the direction of the Canadian versus US dollar. So I'm certainly not going to try and do that. But yes, the Canadian dollar used to be referred to as a petrocurrency, because to your point, oil prices went up, the dollar went up against the US dollar, and vice versa. It's important to note, though, that in the global currency trading standpoint, the Canadian dollar is actually an extremely illiquid currency. And usually when there is a war going on or some geopolitical event happening, there's a flight to safety, and people flock to the US dollar. A lot has been written about, will the US dollar remain, the global currency? Probably it will. The Bank Credit Analyst, which is a great, brilliant publication, actually out of Montreal, in their 2007 year-end issue, they projected that the US dollar would, go into great decline worldwide, and the euro would, be the reserve currency. And we sit here 15 years later, and that's never happened. So it's so hard to explain currency movements. They seem to move for a variety of different reasons. And the Canadian dollar, as let me just tell you, so the Canadian dollar hit a low of 62 cents around 1995, which was the last referendum. And so and then rose to over par. And I well remember having meetings with clients around 2003, 2004. We had bought a bunch of great US stocks in Canadian dollars. And the Canadian dollar rose so much that all of our US holdings were up in US dollars, but down in Canadian dollars. And clients were complaining, why do we have these lousy US companies like McDonald's, Disney, Procter & Gamble? Because the currency moved quickly. So it's such a difficult question. We have no idea. And I don't think there is an answer.
I remember September 11th. Wasn't that the peak of the Canadian US right after like the 2002, around
Possibly.
62%.
Possibly, I mean, I don't remember exactly. But like I said, there was a moment in time when oil was taking off that the dollar was worth more than the US dollar. I should have bought that condo in Florida at the time.
All right. Thank you very much.
Any other questions?
Sorry, just a question to follow up to the last one. It's Jack Patel. For a Canadian investor, given the flight to safety and times of volatility, does it make sense to hedge US investments, Canadian dollar?
So my answer is we never hedge. Part of the reason is so many of the great companies are headquartered in the US. But if you look at, all of them, like Microsoft, Alphabet, which is Google, they themselves have revenues coming in all different currencies. So, if I own Microsoft, 60% of my revenues are actually non-US dollars. So even if I wanted to hedge, it would be really difficult to figure out how much, what percentage should I hedge? I don't know. And we have to just assume that over time, despite the short-term, what can be extreme volatility, that if you own the right stocks, the currencies will work themselves out over time. And, you might end up just losing money on your hedges.
Thank you, Jack Sachs, and then Albert Herskovich.
Yes, my question is following the one of the Canadian currency. If we look at the US currency, considering their debt that it keeps going up, and there is talk about it's going to be backed up, it needs to be backed up by gold, or the yuan is going to take over. What can you tell us about that on the US side, investing into the US side?
So Jack, let me address the debt issues because we find, and listen, I'm not an economist, but we read the numbers. And yes, the US debt, first of all, the US debt is of course the highest level as a percentage of GDP since World War II. But I will tell you, take a look at debt in all of the European countries. It's also like an incredibly high level. Take a look at debt in Canada, it's also at a high level. But there's some good news behind all of that, which is, yes, debt is at this incredibly high level, but look at where bond yields have been. So the US government was borrowing this money by issuing 10, 20, and 30-year bonds at 0.5% to 2%. So the interest expense that they have is not nearly at an all-time high as a percentage of GDP. And so they raise this money at very cheap rates. And the reality is, as the pandemic unfolds, global deficits hit a record high in 2020. They're still probably too high today, but they're coming down and they will continue to come down. We're not worried about it. Second thing is, who benefits with inflation? People who borrow money benefit from inflation. Imagine if you bought $1 million home with nothing down. So you borrowed $1 million. If we get 6% inflation for 10 years, and all you do is pay your interest, but you never pay your principal, your home will be worth almost $2 million, and you'll still owe $1 million, and you'll have created $1 million. So, the reality is higher inflation actually, GDP is rising pretty quickly. So the debt to GDP will once again start declining. But the reality is, to your point, listen, politicians often spend too much money because they're trying to get reelected. But it's not something that concerns us. In the late 80s, Canada had the highest debt to GDP of the G7. And, we were worried we weren't going to be able to pay back our debt. What happened? Jean Chrétien came in, the GST happened. We cut our spending because global markets forced us to. And 10 years later, we had the lowest debt to GDP of the G7. If the debt gets too high, governments will cut back, including the US, and we'll normalize.
Albert Herskovich, I think you have a question.
Thank you, David. Yeah, my question, Lauren, relates to mutual funds. Mutual funds have recently gone down 10, 15, maybe 20%. And during that period of time that you're holding on to a mutual fund, the manager of the mutual fund buys and sells stocks. And then at the end of the year, you get a tax slip with interest, with capital gains and dividends and what have you, that you have to pay the government taxes on. So you, on the one hand, you pay your taxes to the government, but you're losing 10, 15% or 20% on your mutual fund. How do you relate to that?
So I would say, Albert, I'm not going to speak for all mutual funds, and our previous firm got bought by a mutual fund company. I will say most investment or many investment managers will review their capital gains and losses towards the end of the year, let's say late November. And if we've taken gains for clients, we will try to look for losses, so to eliminate the tax bite, to your point. The difference is with mutual funds, mutual fund managers are ranked on their annual returns. So they don't have, there's no incentive. So our last firm got bought by AGF, which is a large mutual fund company. So they don't have an incentive to take tax losses because they're worried if it might impact their performance a little bit. So mutual funds do not take tax losses, but otherwise, most investment managers will review, and most serious investment managers will review investor portfolios at the end of the year and take tax losses where appropriate to reduce the tax bill, but mutual funds don't.
So then I would think then it's not a good investment from what I read from you.
I never like to knock everybody or anything else, but it's something to be aware of. It's something to be aware of when making investments, is kind of what are the incentives, if I can put it that way.
Thank you, Lorne.
We have one last question.
Yes, right here.
Go for it.
Hi, Lorne. I apologize in advance if you touched on this and I may have missed it, but I'm sure you read in the news Peter Thiel calling out Warren Buffett as the grandpa of Omaha. And I was curious, what are your feelings about cryptocurrency?
Boy, and here I thought I was going to have my first presentation in 2 years without anyone asking me about cryptocurrency. First of all, let me say that, two of my longtime heroes in life were the late Jean Beliveau and Warren Buffett. And both of them, to me, besides being great at what they did, they were both modest people. I've met Jean Beliveau twice in my life, same guy that I envisioned him to be. And Warren Buffett, a very modest guy. So I immediately resent anyone who knocks Warren Buffett. And I will tell you, I mentioned the dot-com period. Fortune magazine in the year 1999 put Warren Buffett on the cover, and the tagline was, "Has Warren Buffett lost it?" Because Warren Buffett didn't buy any dot-coms, and so he was wildly offside. And it turns out he didn't. So I resent Peter Thiel. I don't know him personally, so I can make this statement, not talk behind his back. But you're knocking Warren Buffett, you're not a friend of mine. I have to say, I've never met anyone so far who has really given me a reason why one should own cryptocurrencies, except for one very bright Montrealer. So first of all, if I sell a product, if I buy t-shirts from China now to sell them to Walmart 3 months from now, I know what I'm paying for them in, let's say, US dollars. I want to lock in a price with Walmart in US dollars so I can lock in my profit. I don't want Walmart to tell me they're going to pay me in Bitcoin because I don't know what the Bitcoin is going to be worth 3 months from now when I deliver my t-shirt. So I don't think it's useful to most businesses. I think it's extremely useful if you're a drug dealer and you're trying to hide your money, because of course, we live in a world of anti-money laundering. We ourselves have to report suspicious transactions. So if you're doing, illicit activity and you can hide your money, fantastic. However, this one very bright Montreal business person, who's a client of ours, a very wealthy family, he actually gave me a reason why there is a reason for cryptocurrency, okay? And it's very valid. He said, if you live in Venezuela or you live in Ukraine now, or some other place that is falling apart, where, and I'm talking to this audience, and many of you may know people who went through the Holocaust. And a couple of clients of mine went to the Holocaust, like you just left everything behind. and you landed on the shores of Canada or somewhere else with your clothes. And he said the advantage of cryptocurrency, at least, is you can trade in your money, wherever you are. You can buy it on a computer. You can land in Canada with your clothes. You can go onto that computer again, and you don't care if it's down 10%. That's not why at least you have something. And so I understand if you live in an unstable part of the world, there very well might be a reason for you to have some money in crypto. The Argentine currency has basically gone to zero 3 times in my career, believe it. It's collapsed, okay? And so, if you live in one of those countries, it's possible the same way people used to want to have gold, you might want to have some crypto. Other than that, as I said, I've never heard someone give me a clear explanation. Peter Lynch, I don't know if you guys know who Peter Lynch is. Peter Lynch was the great Fidelity fund manager in the 80s and 90s. Peter Lynch said whenever an analyst came to him with an investment idea, he would reach behind him and take out his trusty egg timer, and he would turn it over. He said, if you can't tell me in 3 minutes time why something is a good investment, then it's just too damn complicated. So far to me, crypto is just too damn complicated, but I never said I was the brightest guy in town.
Awesome. I'm going to take one last question from Mimi Leibovich.
I wanted to know if the government of Canada is going to be taxing the banks. The banks have done very well, and my financials have done very well in the last few years. And what's that going to do to the dividends?
So maybe it's a great question. So first of all, they have announced a tax on banks.
Yes.
That will last for a period of time.
Yes.
But there's one thing. First of all, Canadian banks have been a great investment for 50 years, okay? Because Canada is a growth country because we have immigration. And so, Canadians get wealthier, the banks control the market, it's a great place to be. Here's one thing about the banks. You can love them as an investor, and as I said, hate them as a customer. I suspect about 5 minutes after the last budget that just came out, when there was going to be a tax on banks, the banks have already figured out a way how to pass that tax on to you and I. So we don't think it's going to have any impact whatsoever on their profits.
Great. Thank you.
Thank you. And I'll just share one quick story on Canadian banks. So thanks to Danny Charbonny, who asked you a question a bit earlier, Lorne.
Yes.
A group of us used to rent a house in Stowe, Vermont. And so Danny said, I'm starting a Stowe fund, and we're going to buy the 5 Canadian banks, and I think we all put in like $1,500. I think we were maybe 10 of us. And basically he never touched it, didn't touch it, never, cashed anything out. The dividends kept coming in, so on and so forth. And I think maybe 20 years later, somebody said, you know what, I'd like to get my money out. And so we decided to liquidate the fund, the fund. Well, it wasn't really a fund, it was called a fund, right? We sold the stock. And I think my $1,500 was like $15,000. And that's just sitting on it for all those years. So
the message from that, David, is hire Danny to be the investment manager.
Yeah, exactly. So look, I'd like to thank you, Lorne, very much. Like, even though I know you well and I consider us to be friends, I love like having lunch with you. I find you're so smart, and the way you speak is so interesting and so insightful. And so I'm thrilled that you agreed to come on and spend this time with us. And I hope that all the audience has enjoyed your talk. I'm sure they have, because I think it was fantastic. And so I'd like to thank you again. I'd like to thank Oren. I'd also like to mention that, Lorne has been a supporter of our synagogue in last year's annual giving campaign. And, Oren as well, him and his family have been, part of the major donors program and also supported the annual giving campaign. And Oren sits on the executive. And so, as a busy guy, he's giving of his time and energy. And so, this is a Spanish and Portuguese event. And so I felt it would be remiss not to mention that we very much appreciate your support, Oren, and yours as well, Lorne. And so just as a note, we have 3 more speakers scheduled, well, not speakers, but speaker events scheduled. So on April 26th, we're going to have from Richter, Tasso, Lagios, and Tasso is the managing director. He's basically the boss at Richter, and Alana Geller, and they're going to talk about transforming your family business. And we're going to have the honor of having Oren Gabai from RG Coffee introduce Tasso and Alana. Then on May 11th, we're going to have HSBC is going to present on sustainable financing. So I think that's a really interesting topic. So Jonathan Raymond is more or less in charge of the Quebec, of the Montreal market, I believe. And Angie, I think, is a specialist in sustainable financing. And they're going to be introduced by Ronald Rubin, who runs Medicom. And Medicom is in the PPF business. And so I'm sure he's going to have some really interesting stories to tell us about the impact of the pandemic on his business. And then finally, on May 25th, we're going to have Tasso back along with Justine Delisle. They're going to talk about establishing your family office. On that date, I'll be introducing Tasso and Justine and talking a little bit about my business transformation. So I hope if you like this, spread the word, register for sure for the next 3, and spread the word, because the more people that attend, the bigger base we're going to have. And there's so many things we can do down the road that I think could be really interesting. Thank you very much, and hope to see you guys at the next speaker event. Have a great day, everybody, and happy Passover to all.